Ladies and gentlemen, good day and welcome to the Q1 FY23 earnings conference call of Ramco Systems hosted by DAM Capital Advisors Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Anmol Garg from DAM Capital Advisors Limited. Thank you and over to you, sir.
Thank you, Rituja. Good afternoon, everyone. On behalf of DAM Capital, we welcome you all to the Q1 FY23 conference call of Ramco Systems. We have with us Mr. P.R. Venkatrama Raja, Chairman of the company, Mr. Sandesh Bilagi, Chief Operating Officer, Mr. R. Ravikula Chandran, CFO, Ms. Gayatri, VP Finance, and Mr. Vijay Raghavan, Company Secretary. So, without any further ado, I'll hand over the call to Mr. Venkatrama Raja for his opening remarks. Thank you, and over to you, sir.
Yeah, good afternoon, everybody, and welcome to this conference. And I think all of you would have seen the results for this quarter. The result for this quarter is a reflection of the low bookings we've had in the past few quarters and the increase in manpower cost due to the attrition and the increase in manpower we need to make sure that all our implementations are going well. But I think that we have stabilized, and the good news is I think all these measures have made sure that our bookings are back on the rising level, and this quarter's plus $20 million and plus close to 21. So I think the measures we are taking is taking us back to our normalcy in booking. And once the bookings keep growing, I think we'll be back to normal and the growth will be there. And also there are one or two key implementations that are going on worldwide, which will be key for our future growth. So we are investing heavily to make sure that those implementations go on very well. That also is increasing costs a bit. But the good news, again, I will say, is the bookings seem to be on the path of rise again. So with this brief introduction, I'll hand it over to Sandesh to explain the whole results and where we are going. And then we'll take the question and answer. Thank you very much.
Good afternoon, everyone. I will give this business update in three tranches. First, I will discuss about the bookings for the quarter and important aspects of the booking and how we see about markets and the pipeline and other aspects. And second is on the revenue, the impact of bookings and past and on the revenue. Third is on the profitability and cost. And then probably I will touch upon some of the key aspects of pipeline and some investment and things what we did in the last quarter and how it is last few quarters and how it is impacting our business. Then we will open it for question and answers. Current quarter, we booked 21.77 million, which you can say is close to $22 million booking. This has been our one of the good quarters in last 5 years. 5 quarters. This is a top revenue booking quarter in the last 5 quarters. Especially on the back of Q3 and Q4 of last year, which were $13.5 and $12 million. Now we have clocked almost double of that on an average, and this is mainly signaling to the markets opening in all countries. Especially in Asia in the last year. And before that, we had impact, and that is what we had informed you all in our previous call. And we were seeing that market is opening, and that also should start showing in our results. Consequently, opening of Asia, around 30% of our order booking, close to $6 million has come from Asia Pacific, which we are seeing almost all countries apart from Greater China and Hong Kong. Most of the geographies we are able to see deals moving discussions happening and lot of demonstration and other with customer in person. We are able to engage well, and we expect this to continue in coming quarters, and pipeline consequently moving towards that. Now, if I have to tell, there is some very interesting aspect on the quality of the deals which we have closed in this quarter. We closed around $5 million deals in this quarter, which in comparison to last entire last year we closed $13 million deals in the entire last year, and we did that $5 million deals in this quarter alone, and
$1 million plus.
Yeah, $1 million plus deals, and 5 of those deals are in the Fortune 200 and Fortune 100. 2 of them are in the Fortune 100s, and 3 of the deals are in Fortune 200s. 2 of them are pharma majors, and 1 in staffing company, and other 2 are in retail and CPG. So across a chain, across geographies, we have been able to acquire very prominent logos in as and when we have permission to declare those names. You will be able to see that in our press release. We will make it public as and when we are able to get the press release concurrence from our customers. Another aspect of quality of deals, if I have to see, average deal size for this quarter stood at around $1.2 million per deal, which in the last 2 quarters had dropped below $500K, which consciously we were looking for getting the large deals, and I think in current quarter there are, and also in the pipeline we are able to see good number of large deals maturing for the closure. And last 2 quarters back, we did invest in defense subsidiary in the US, part of our expansion plan for the aviation and defense, what we call as the AAD business. In that, we did invest in subsidiary and few local hires in Germany and in US, ex-army personnel and all, which we had undertaken some investment activity. We are able to see some deals closing in this quarter. We had 2 deals, a part of our defense subsidiary, which we closed. Interestingly, those are the, one of them is a drone company, which is used for the defense, and the other one is the contractor for the US defense. So both of these, orders which are starting in small to medium, what we can call, and we are able to see good execution here will open a lot of opportunity in this segment. That is what we are intending to do, and that's the reason we had made some good investment in defense. And the other interesting in the AAD business which we closed is the civilian area, that is for the eVTOL, that is the urban electric vertical takeoff, which we have closed, which is another major in the eVTOL. Of course, the market here will start opening up in year or so, when commercially eVTOLs will be supplied by these companies for the consumption at large. But we have started good beginning both in the eVTOL and drone. Apart from our quest in helicopter segment and MRO segment, we have opened up other lucrative segment in our opinion, which should start helping us to book more orders and also gain foothold in this industry as and when it starts maturing. We have made a good beginning there. And we were also giving the update on Oracle and Workday, where we have partnered and we have built connectors for seamless existence with both Oracle and Workday globally for the multiple countries of our 60 odd countries where we have our payroll. That is what we spent a lot of time in building that. And out of $12 million closure for the HRP business, around over 70% of this booking came from core HR from either Oracle or Workday. I think that is another sign. I think the investment and the work what we had undertaken in the last year and prior to that has started yielding, and that trend we see it in our pipeline as well, and we are working very closely with these two organizations to see how we can serve our common customers better. And now I will move on to revenue. There are some more data points are there. I am sure part of questions we can cover more on the order booking if you want to know. But now I will just give my views on the revenue side. For the quarter, current quarter, we closed the revenue at 15.7, which typically, if I say on an average, we were 19.7 average for the last few years per quarter. I think that is around $4 million drop. That is one reason of that is consistent low booking what we had in the last few quarters. That has resulted into roughly around $2.5 million impact on our revenue. Mainly it is related to services revenue. If you see our recurring revenue, most of them have remained flat or slight increase. Like in case of BPO, we have seen around 20% increase. Rest of the recurring also either flat or slight growth in that range. But services did have impact of around $2.5 million an average. That is mainly because of consistently low booking which is there, and we are able to see that now with the $22 million booking, and we continue to look forward for booking more and more orders in coming quarters. If we are able to, we will be seeing this reversal of downtrend, which looking at the order book, we fairly confident that it should be in the direction of we booking similar revenues or upward. That is our attempt, and that is what it is looking like. And this revenue slide should start looking better in coming quarters. Second impact of that is, which is a very conscious decision on the business model change, which we explained earlier, which we have adopted. That is deferred, which we were making the deferred payment for our revenues for the licenses. Now we have stopped and we are moving more on annuity business. Almost all business in the current quarter, 100% of them we have picked up on the annuity or direct license without any deferred payment model. What it means is we are moving cash collection and revenue very closer, so there is no a gap in between, and our unbilled revenue portion will start improving, number one. Second, we will also start seeing our recurring revenue start improving with this change, and I think we will not also carry the risk of any of the project risk. We will not retain at our end. It will be between the customer and us. It will be quietly well balanced, and we see that structural adjustment is around $1.5 million to $2 million on an average when I compare for the past quarter. So that probably will start showing improved revenue in recurring revenue as and when we start going live, rather than upfront revenue being recognized because of deferred payment model. That's the structural change, having around 1.5 million, which we see changing for the better from here onwards. And now I will move to the last portion here on the net loss, which is from 3.55 to 6.64, which is for the quarter on quarter. If I say $3 million loss, 1 million is consequent to drop in the revenue from the previous quarter, 1 million impact. 1 million is because of the increase in employee cost, which we had to make because of industry attrition challenges what we had to. Consequent to that, to address that, we had to make some salary correction, and also we have to make retention payment and bonus and other schemes which we have introduced. Also, we had identified top 20% of the people in the company, and for them, apart from the retention, we also have provided ESOPs to retain the talent, which is very critical talent, top critical 20% of the talent. That has resulted in increased both headcount, and these measures have had the impact of around $1 million increase in the wage bill. That is the second. And the third one is exchange fluctuation. In the last quarter, we had $500,000 gain on the exchange fluctuation, and current quarter saw $500,000 loss, effectively $1 million impact due to exchange fluctuations. This resulted in around 3 million overall impact onto our bottom line, and with increase in order booking, and I think going more live, we will start seeing recovering in the revenue and bottom line. I think that is where my roughly on the business comment I would conclude here, and I would look forward for engagement with you and provide any more clarifications or any questions you have. We are open to.
Thank you very much. So we'll now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Rahul Jain from Dolat Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity. Just one or two clarification, and then I have one or two questions to ask. Firstly, Sandesh, you were saying about this 1.5 million kind of an structural adjustment by moving towards SaaS. Are you trying to say that your revenue recognition is lower by 1.5 million because of this shift, or is there anything else which you want to say by that?
Rahul, this is RKC. I'll try to answer this. See, earlier we used to get the licenses with a deferred payment model, and we are consciously moving away from that one because that gives a mismatch between the revenue recognized and the cash inflow. So now we are also persuading customers to go either for a pure license model. We had a couple of orders like that in this quarter, or we are requesting the customers to go for a normal subscription model or an annuity model. So that is what Sandesh was referring to as a structural adjustment.
So, RKC, so this 1.5 million is the run rate in the current revenue, which is at risk. Is that what the understanding is? How we come to this number actually?
How did you come up with one?
Compared with the previous quarters, around $1.5 million was related to deferred payment model, which we have, completely asking customer to pay. We are only taking month on month moving forward, and I think that is the impact of that is around $1.5 million in a quarter. That is what, the estimation.
It is a comparison, Rahul. Sandesh was comparing that our average revenue run rate is 19.5, which has become 15.7 this quarter. So there's a drop of 4 million, and was trying to give an idea of how that 4 million drop has happened.
Okay.
Basically, it's difficult to say whether we could have, if we had followed the same model, whether we would have had 1.5 million. It's difficult to say because we didn't even negotiate that way. So it is difficult to say that. It's just a statistical analysis on this one.
Understand.
Say yes or no.
Yeah. Got the sense now. And thank you for that clarification. Now, my another question is, of course, the booking in this quarter is exciting, and which can kind of improve our revenue recognition also because of the new preference of annuity model, which will also reduce the receivable part of the thing. So just two things more. I understand the run rate has come down for the factors which we've been saying for last couple of quarters. But for us to go back to the path of profitability, we still have to cover up a gap of close to $7 million on a quarterly run rate basis. And for that, the revenue run rate become closer to $23-24 million. So in past, when we were doing average booking of more than $28-30 to $1 million, we were booking revenue of $20-23 million. So how much that looks like a possibility over next 2 quarters? And let's assume if we move from this $16 million revenue to $22 to $24 million revenue, what could be the cost base increase to service that kind of revenue stream?
Yeah. I'll answer it in a two way. I think the first is on the what you asked on the what are the possibilities of reaching to $22 million with the increased booking, and second is on the serviceability, our capacity to service where we are. First one, I think our attempt is to actually go back to. I think the first is we had to stop this slide, and I think that is from the market and other whatever I explained that we are looking like, which we have done. I think now is about increasing it to 20, 26, and probably higher than that. I think that is what we all are working towards. I think all the investment which we spoke about in the marketing and other aspect of people on the field being increased, or the spend and events and multiple others required for increasing the pipeline, all that action we have taken with intent to increase significantly higher than that. It will be possible, and I think it is looking like, but I won't be able to make a comment. Probably I will be guarded for a couple of more quarters before I make that judgment on. But it is looking like positive from the pipeline moment. How in the current year probably to bridge that gap, some of the aviation, ERP, and logistics businesses, we will continue to take some license deal to bridge that gap until we are able to move completely onto annuity business. So that we will try to do to bridge some of the revenue gap. How much and how it will be over the quarter we will come to know. I think our idea is in the current year first to actually break even and then start looking into showing good growth, because our annuities would have started kicking off in 2 to 3 quarters time from now.
Right. So if I could stretch the conversation a little bit more. So what I was essentially trying to understand, let's assume without asking you the specific timeline, as you said, it would be tough for you. But on the what kind of order book number can bring us to that $23-24 million kind of a run rate, and what kind of cost increase it would happen by that time? So is it like the current capacity based on whatever spend we are doing on a run rate basis are good enough for us to take to that kind of booking and revenue, or it has to come with more investment?
I can answer that. I think, Sanjay, you want to answer that or I'll answer that?
No, you go ahead, PRV, then I will jump in.
So basically, the capacity we have built is, we are actually with a very big capacity now, because we also wanted to make sure that, all the implementations that are going on are speeded up and customer satisfaction is improved. Because of COVID, a lot of things were lagging. So we built up the capacity to 2,200 plus number of people also. So I think this capacity is probably more than enough to reach the $23-24 million number you're talking about. So therefore, the only cost increase will be the salary increases necessary, which may not be much. So structurally, I don't think we will increase too much more people unless there's a dramatic increase in order booking. But at this rate, I think it's more than enough to reach the 25 million revenue. It's probably more than enough. Is what I would like to say. Yeah.
Fair enough. Another.
Just a minute. I think there is another thing I would like to highlight also here. Due to response to our COVID, I think we had to increase our on-site delivery capabilities because we were not able. Mobility across globe was a challenge, but our interaction and we had to improve in the last few quarters our engagement with customers. So we resorted to more heavy on-site workforce, and which probably after completion of some of the major projects which Mr. Chairman spoke earlier, that would be, their India-based resources will be working back again from India. That would give some saving in the salary cost. Though the number will remain same, we are anticipating in coming quarters we will be able to make that adjustment also to better improve the salary cost. And capacity-wise, I think we are geared up for addressing some of the growth which we are anticipating. Already we have built up capacity for that. That we are currently utilizing for servicing previous orders which we had closed and to get our customer on to go live.
Right. And if I can squeeze in one more. So basically, from a growth momentum perspective, I think you shared more confidence on two segments, which is HRP and aviation. So firstly, on HRP, you said 70% of new deal win has come through partner channel. So can we say that how many country rollout connector has been rolled out? And are we seeing your per deal realization improving significantly as a metric of that, because the size of the deal this partner must be choosing must be much higher? Or any other flavor you want to give on that part?
Yeah. On the partner wise, I think, both of the Workday and Oracle have a different way of integration and certification process. For Workday, we have already done around 6+ countries and 6 more are in line. Our attempt is to actually get certification all across. It's a continuous process and we are working. There is a dedicated team looking into that one. However, with after completion of the one country, it doesn't take same amount of effort for all countries. It is only incrementally more effort. So we will be able to roll out more and more country certification through this connector. Same with Oracle, we are invested at the OEM level. So that is the global connector concept what they have. With that, we will be able to go for more countries like in Workday I spoke about. Second, in deal-wise, I think what I spoke, some of the reasons of Fortune customers what we have seen also are a result of this, and pipeline buildup is also looking better, and our conversion from pipeline to win also has seen some improvement because of having the success in these connectors what we have built. Right now, I think deal size and realization, it is too early for me to comment, but that is our expectation. With all this investment we made, with that intent that we can have a repeated business, and we will be able to go live quickly, and we will be able to service our customers, joint customers, quickly to go to market so that we can quickly start our recurring revenues to improve. I think that was the intent with which we did, and all those things seem to be working in that same direction.
Right. Just last one question on the debt and potential need for funding for given the kind of run rate of cash flow that we are right now. Do you think we would be in situation to raise money in any form, debt or equity, in this or subsequent year, or you think with reduced working capital requirement, we may be able to manage with a small debt on short-term basis?
We are not looking for any of the debt or equity raising activity at this level. I think our attempt is to actually retire this temporary debt which we have created in the quarter with two. One is on the more booking and other go live, what I said, and some of the go lives, some of the very large go lives which we have will also enable us to invoice our customers, which are in next 2 quarters. Some of the major projects are going live. So we anticipate we should be able to manage for the working capital level. We are not looking for at this stage any of those debt or equity rising.
Right. Fair enough. That's it from my side, and I'll fall back in the queue. Thank you.
Thank you. The next question is from the line of B. Suresh for Burams Financials. Please go ahead.
Hello. Hello.
Yes, Suresh.
Sir, good evening, sir. Giving the opportunity. Sir, you will give the annual report to $180 million order book unexecuted. That order will not go live, sir, this quarter. Why, sir? And a large order book is unexecuted order book is there, but sales is not increasing.
Usually, when you start getting order books, to realize these order books, it usually takes 1 or 2 quarters for you to start seeing the effect of that. Like you saw the revenue fall, and you saw a lag. I mean, the order books fall, and you saw the lag in revenue fall. And now you can see the full impact of the low order booking. Now, as the order booking starts increasing, you see a gradual increase in the revenues, and then it will start. So when you consistently start booking higher and higher booking per quarter, then the revenues will stabilize. So that is the pattern here, because usually it takes anywhere between 3 months to 8 months to go live and realize the full potential of the order booking, and sometimes even 12 months, because the projects may be large. Yeah.
Sir, so many years we can wait for investors. You give the every quarter, and the order book is there, but attrition rate is increased. How to manage the funds in future? How much can take, sir, in profit? Company going to profit? You are a managed company. You are good people. But what time will take the profit making company? So many years.
I would not see it in that way. I think it is the cushion for the future. I would see that as the order booking. Typically, we book for the 5 years whenever we book the order, and that is what is represented as the unexecuted order book. Number one. Second, that is we consume over the period. First, on the major portion of that will be usually implementation and go live. Majority we do, and then we leave it for the rest 4 years also on a support activity or subscription or any other thing to go. So from that perspective, we have in our bank, you can see it as around 177 million currently, if you see on the June 22, which we expect to exhaust in next 5 years. I think that is how 5 to 6 years. That is how I see, not as that can be all encashed in one quarter. I think that is not the idea. I think it is to give the stability to business. I think that is why we are, representing that through unexecuted order book, and that is what we conveyed earlier. And then for the investors' consumption, we thought we will also start publishing the unexecuted order book so that you will be able to have view, just not for the 1 or 2 quarters, probably for the longer term as well.
And how much years, sir? How much quarters it will take, sir, that order will take? How much time it
Suresh? No, he has already explained. See, this is an order book, unexecuted book. We will be able to, it consists some portion of the service revenue and some portion of the AMC. See, our order size, period is normally 5 years. So this order book can go anywhere between 3 to 4 years, and we'll keep on booking fresh orders. So this will be consumed, to your question, will be consumed over anywhere between 15 to 20 quarters.
Sir, next quarter, it will take time. Company is going to profit. How much time takes?
See, question is on the profitability. See, idea is to first stabilize, grow, and then talk about that, Suresh. It will be difficult to give. Yeah.
How much time, sir? At least. So next quarter, it will give the profit. Next quarter or another quarter?
I explained that, I think, earlier. I think this year will be on the rebuild activity, and I think our attempt is to increase our revenue through a bit of licenses revenue in the 3 segment to bridge the gap between the cost base which is there and revenue currently where we are, to attempt to break even in the year. I think that is what
This year is break even, sir. This year is break even.
No, we will not be able to guess. Suresh, it will be a guess to whether we will be able to break even. The idea is to increase the order book. See, we have fallen in the order book position. So now we are slowly coming up. So this quarter we have done 22 million. Idea is to go back to the previous position of where we have done on an average 23, 24 million order book. So that is a target immediately. So revenue will depend on that. Whether we get a license order, whether we are going to get an annuity order, will determine that quantum of revenue. Based on that, others will flow, the bottom line will flow. So that will be difficult to predict at this point of time, Suresh. And we also don't give the guidance of whether we make profit or break even next quarter, etc. Okay?
Sir, okay. But it can, at least this year you will break even, sir. This financial year.
No. We only wish that your wish comes true.
Implementation problem, sir. Projects implementation problem.
This we have already explained in the previous call, Suresh. So if you have primary questions, sir, my suggestion is you can think and come back so that others can ask some more questions.
Okay, you can try to implement Go Live for some projects. And you can expand the implementation consultancies, vendors. You can add the more fast Go Live will give.
No, noted, Suresh. Noted, Suresh. Yeah.
Thank you.
Yeah.
The next question is from the line of TVK Vivek Kumar from Best Pulse Research and Advisory. Please go ahead.
Good evening, sir. Are you able to hear me?
Yeah.
Sir, good evening. Thanks for the opportunity. See, this is a very top-level question. We have been investing on product, upgrading the product, this HR product in terms of connectors, and then logistics, ERP, and we have also gone into new geographies while 4 or 5 years back we were mostly in Asia. So can you explain us product-wise which product do you think have already crossed investment in terms of even the marketing teams and all, and where do you think in the next 2-3 years we will see which product will contribute our increasing order book and where we have more investments to make and still we are in the investment mode? So if you can, it's a very top level, if you can give us more. And I think if it's clear, I think...
Yeah, get your question, yeah. Understood, yeah. Sandesh, you want to take it or should I take it?
You can PRV, then I will do that, I think, but yeah.
Yeah, I think by end of this year, most of the investments required for our aviation product would have been done. As these very large implementations going where we are investing a lot of money, that would be done. So I think not too much more investments in that area except refinements and so on. That is one. The HR and payroll, that HRP market, our investments will be continuous, but the incremental investment will not be as much as we've been doing now. Now it's all about booking orders and executing there also. In our ERP, logistics and this business, there is some investments to be made. Maybe for another year we'll have to make some investments, but that may not be as very, very significant. I think the important thing now is to basically make sure that our automation, which we're doing in execution, that is where the investments will be going in terms of automating our testing and execution and implementation and so on. That is where we are shifting most of our investments to. And that has been working for the last year or so. And that investments also will be continuous in the next year or so. So given these things, I think it won't be a huge major jumps in investments, but there'll be continuous refinements going on. But I think we are in a position to start exploiting the full investments made in aviation and HR by the end of this year. And maybe another 6 this financial year, maybe another 6 months from that, maybe for our logistics and SRP, ERP business, we can start exploiting. So that is where the whole thing stands. I don't know if that answers your question. Maybe Sandesh, you can correct it.
Yes. Yes.
So, which products do you think will drive our order booking in the coming quarters or years, in the next 1-2 years?
I think in the immediate, go ahead, Sandesh.
Yeah. We gave a clear this one last beginning of the year, and we hold that one. I think from perspective of AAD and HR, which are quite advanced, and I think the investment, whatever we had to make, I think they are in the stage where we are exploiting. That will start with the initially HRP and AAD will drive the growth, and then followed it up with the logistics, and little bit work on the logistics and the ERP we have to do. That also will join in a year's time or so into this one. So till then, I think the growth will be driven by AAD and HRP, and then I think we are very clearly focused on only these 3 segments now. So I think that also will join logistics and ERP in coming years.
So one small request, I've been asking this in the previous call also. If you can make a presentation regarding the specific niches that you're like in HR, what are the specific niches and geographies, and what is your pipeline, who is your competition, and what are the order books? If you can mention in a presentation, because every con call asking the same question, and if you can do it product wise, like if it's AED, what are the niches you're addressing, who are your competitors, and how is the pipeline looking, some commentary like 1 or 2 page as a table or whatever, so that we understand where things are going product wise, both in terms of competition and your exact niches that you are trying to address, and where the pipeline is, how the pipeline is looking, and how is your win rate, and whatever you think are the metrics that we should track to understand you better. If you can put it in a presentation, I think it would help us, sir. Like it would also increase the number of questions in the con call, and we can ask better questions.
We will do that. I think we just attempted that in the Q1 at the beginning of the year. We will do that. Quarterly, I'm not sure whether it will be feasible within the the investor meeting, but probably we will do twice a year. We will try to give that commentary.
When you say payroll, it's such a large market. It would better help us understand the company if you can exactly pin down to the niches that you're targeting, who are your competitors, what is the pipeline, what is your opportunity, whatever you think is relevant for us to understand you better. I think so that we can ask more specific questions and get more clarity on how the things are, instead of just asking what is the loss, profit on all these things. Because we will not able to understand how the company is like transforming or changing dynamically unless we have this data is what I would assume.
But you are looking for more qualitative data on the entire thing, which I remember your request last quarter as well. We will implement, may not be for the quarter, but we will do, half yearly, we will try to do that.
Because when you say logistics, there's like such a big space, there are so many companies addressing, so if you can little bit help us as a corporate presentation, where are you actually addressing, what are the markets and niches or anything, whatever you think is important for us to understand.
Yes, that's fine. I think we will give, but for your clarity, I can just take a minute to explain in the niches where we are working in the payroll. It is, I think we said, into around 60 countries payroll. You can consider as the east of Turkey, almost every country we service, and that is our niche area. And when we say in the payroll, it is HR business, HRP what we call, is any operational HR that is related with employee, their records and payments and time, all these aspects and engagement into that one. That is what comes in part of that one. We will give more commentary on each of the geographies, growth, opportunity, competition, how we are seeing more detail in that.
Yeah, and also pipeline and how your win rate is, so that it is more easier, sir.
And similarly in aviation aid business, that is in the mostly MRO, that is what we MRO and engineering, anything to do with these businesses, everything we take care of in the segment of helicopter, fixed wing, then MRO, and now we have started dealing in eVTOL and drones as well. So almost we cover breadth of the market in MRO and entire, gamut of things there. That is for the aviation segment, and that is all across geography. We have customers almost spread all across. And then the logistics is purely very niche, servicing the LSPs, what we call as the logistics service provider, that is the 3PL or 4PL, into TMS, WMS, finance, rating, billing, visibility, and other area for an operator to operate everything we are able to, and maintenance of the truck fleet, whatsoever you call, that is the segment we work. But I get your point. We will do that through properly indicating which niche areas we are and the size of the market and the pipeline and what we are seeing and the movement in these areas as a commentary we will provide.
Most of the geography where you are targeting and also competition, so that we can understand where you are actually playing. Because it's such a market, ERP is such a big market, so how to pinpoint where you are. So if you can make it competition and specific areas and niches, that if you can do that, it would help us understand your company better.
We will try to do that. Yeah.
Thank you. Thank you.
Thank you. The next question is from the line of Darshan Zaveri from Crown Capital. Please go ahead.
Hello. Good evening, sir. And congratulations on getting good orders in this quarter. Hello. Am I audible,
Yeah.
sir?
Yes, Darshan.
Yeah. So, sorry, sir. Actually, my line got disconnected in between. So, a previous participant had asked a question regarding what kind of order book will we need to reach 25 million revenue, sir. So, could that be clarified? I'm sorry, sir, for repeating the question.
Yes.
No, the answer is it depends on the composition, Darshan. See, what is the order book? See, currently we have done 20 million order book, which is up from the low of last quarter. And our aim, we explained that we want to come back to the original position of the 25 million order book. If we have the order book of that nature, still it will not be able to get us 25 million revenue. will be less than that. And it also depends on the composition of the order. Are we getting an order from a defense or aviation for a good license order, or it's going to be HRP or a logistics subscription order or a payroll processing order? If it is good, these will be annuities. So, we are unable to predict what type of the composition, what is the composition of the order book for particular cost. The revenue will be a dependent number of that order book composition.
Oh, okay. Thank you, sir. That helps a lot. So I have two more questions, if I may, sir. One, regarding our cost, I'm assuming that we have plateaued right now. We have reached the peak, and we will not see any significant other cost increases.
Yeah, I mean, salary cost we explained. I think that is the area we were reacting to the situation we have. I think most of the IT companies are anyway facing that one, and I think that's a global in nature as well. So that we have done. Most of the cost increase we have seen has come into personnel cost. Okay, I think we expect. I think that should be sufficient for us not to cover more. However, on the last call also we said more expenses we would be incurring on the travel side. Little bit higher it will go, because I think that is market has opened and our interaction and engagement has to increase much more. We will be spending little more on the travel and marketing expenses. And as we start seeing the market and growth potential, we have planned for some sales people on the ground expansion, but for that we will wait to see clear signs of consistent increase in the order booking for the sales increase, but probably marketing and travel slight uptick will be there. That's the planned activity, because typically marketing expenses will precede order booking and sales by few quarters, and we would have to do that, and which we have planned in the current year to increase our spending on marketing. That area will see a little bit, but all other costs, I would say, likely that we have covered at the current level.
So, could there be a ballpark estimation of how much, either percent or how much marketing cost was last year and this year, or traveling, how much is going to increase? Any ballpark figure we could estimate, sir?
See, travel cost, if you see, earlier we are spending $1.5 million per quarter. That was our run rate before the COVID times. Now we will be slowly reaching that, if not at the full thing. At least 2/3 will be reaching now.
Okay, sir. And I just have one more question. So, what kind of risks do we see in, that could be a roadblock in our road to recovery or something? What's something that might just hurt us?
Same, that's the general same risk what other businesses are seeing, the geopolitical risk we see. I think the whole dependency, I think what we are seeing is the coming back on the order booking. I think that will determine most of our downstream revenue and downstream profitability depends upon the order booking. And that is one of the risks which we had identified earlier on the market being closed, and that has now looks like it has opened up in most areas with the activity we can see. Geopolitical risk remains like any other business, and the recessionary environments we are seeing in the US and Europe market. We have to see if at all it will have any impact. But that is the unknown risks. I would not comment, but that is as identified like any other businesses. Those two are on the record to see. But otherwise, inherent business risk, what is required from our business perspective, we have started, whatever investment we had made, I think going live quickly and product refresh and investment what we had to make, or under investment in certain activities, all the corrective actions in last 3 to 4 quarters we have taken, and we have identified also to do that. Most of the work is done, I would say, in that area. which is known risk, how to tackle that.
Okay, sir. Thank you. That's very good to know, sir. Last question, sir. Due to any recessionary fears, are we seeing slowdown in orders? Because our orders are increasing, so I don't assume that we are seeing any slowdown in orders, or is there some hesitancy for companies in undergoing large investments right now due to this fear?
We have not seen. Right now, we have not seen that, but that is just on the watch list. You asked me the risk, what it is, so I said. But based on the activities on the ground and based on the interactions what we are seeing in quarter, we have not seen, and even after short months what we have, I think that is not seen currently. We would have to just wait and watch.
Okay, thank you so much. That answers all my questions. Thank you so much for giving such a detailed answer, sir, and all the best, sir, for the upcoming quarter.
Thank you.
Thank you. The next question is from the line of Shiva Subramanian, an individual investor. Please go ahead.
Good evening to you, sir, and congratulations on a good set of order booking. First, I would like to know is what is the cash flow for this quarter?
Cash flow, we have burnt cash, Shiva. We have a loan portfolio of 46 crores.
So it's been negative for this quarter, right? Because I think end of last year you had a cash flow of 90 crores approximately.
No, the end of the quarter, if you see net, we had a zero borrowing.
Okay.
So opening also zero and closing also zero. So whatever, the operating cash flows and the investment and the financing cash flow, they have matched. So this quarter, we could not do that on a quarterly basis. So we have an operating burn of 46 crores.
46 crores of borrowing that you have done, is it, for this quarter?
Yes. 46 crores rupees.
Thank you very much. My second question is about the bad debts, right? We started the writing of bad debts from Q4 of 21, and you said after 6 quarters the bad debts would be through. You had estimated an amount of 75 crores for the 6-quarter period, and I think we have written off somewhere close to 85 or 86 crores for the 6 quarters. So my question is there any other provision for bad debts that has been done, and what is the bad debts that needs to be written off for this financial year? Is there anything that you identified?
See, for this quarter also we have provided 2 million as a provision, Shiva. So
right, I understand. I think you started off 57 crores of full financial year last year, and Q4 was about 12 crores and about 16 crores. That adds to about 85 crores for the 6 quarters, where we had provision only for 75 crores of bad debt.
Yes. No, it is an assessment done periodically, Shiva. This we have explained in several calls. See, it depends on the project.
So what is the bad debt you are looking at this point in time that needs to be written off? Is there a bad debt that's going to be written off for the next quarter? Is what I want to know. Or for the end of this financial year, do you recognize any bad provisions or bad debts?
No, 2 points. See, one is the bad debts is write-off is the next one. We are providing for the expected loss. See, you are supposed to make provision for the expected credit loss, which we are assessing periodically and providing. So this quarter we have done 2 million, and most probably we will continue this for the year. And whatever actually we are not, see, in our case, there is nothing like a customer becomes bankrupt, etc. It will be our inability to recover from the customer if the customer is not satisfied. This we have explained in several calls. Just to recap, I am repeating. See, if you take our balance sheet, we have 9.5 million of the provision. We have a reserve. If you see the balance sheet of last year annual report, you will see 9.5 million as the closing bad debts provision. So this quarter we are providing. We have provided, in fact, in the results, 2 million have been taken, and we expect this to continue for the next this year, the next 3 quarters. So it's an assessment done at a periodical basis, Shiva.
So you have a bad debt of what?
We will not be able to fully foresee whether See, idea is to do the projects quickly to satisfy the customers and get them back. But if for some reason we are unable to do, then we don't want to load the P&L all of a sudden. So the business is like that.
So approximately 2 million for the next per quarter for next 3 quarters is what we foresee as being written off.
Yeah. Then we feel this will be adequate, Shiva.
Right. This question is to Mr. Venkatramaraju or Mr. Sandesh Pilagi. What is the terms of agreement that we have with Oracle or Workday? That is there a revenue sharing agreement or is it a profit sharing agreement? Is what we have entered into with these two companies?
No, that is not that is the partnership. I think it is a purely certified connectors or the connector between the two applications, so that every time you don't reinvent the wheel. So standard connector we are doing, the single purpose is jointly, the customers who are joint customers for Oracle and Ramco, we are able to service, and we are able to make that as a predictable connector, so that we don't build every time new. And I think that is the program. Both of those organizations have certification program for choosing that partner, and securely we have built the connector. I think that's the relationship we have. That is what they call, the.
So do we have to share any profit with Oracle or Workday? Once the profits are recognized, do we have to share any profit with them? Profits with them is what I want to understand.
No, that is not the, it is not a profit sharing relationship. Either.
Okay, so the entire profits comes to Ramco system is what is my understanding, right?
That is correct.
And my final question is, I think in one of the interviews recently you had mentioned that we're processing about 2.5 million payslips a month. So where are we at this point in time? And what is the average cost per payslip is what I would want to know, in case you have a figure for that.
See, I think we are on similar growth. We will, 2.75 or something we would have grown now on the payslip. But per payslip cost, that is very not a right figure it will give. Mathematically it will be right, because we have, we can give a figure, but that will not be depicted correctly, because the composition of that depends on 3 factors. One is the geography in which we are dealing. That is all across 60 countries, there are very different rates which we apply, number one. Second, it depends upon whether it's a platform deal or whether it is managed services, what we call as we manage and provide the services for processing the payslip, or customer processes using our platform. And third, we also have our partners who are using our platform to process the payroll, and in that case, it's a different rate we adopt. So combination and permutation of them, you can just imagine for the 60 countries how we will have. So if I give a mathematically average rate, it may not be the accurate, because a lot of things will change based on number of headcount coming in each of the country. It can change.
Because my understanding is that in European countries, it's the rough ballpark figure is about $4 to $5 is what was my understanding. So I just wanted to get an idea as to what is the amount that Ramco gets per payslip was my question. And finally, I think we have a very strong base in Asia. So what are the steps that you have taken to improve our base in Europe and US? Because that is where money basically is. I just want to understand. Thank you very much.
Yeah, I think there are two things you asked. I think on the rough average cost, I think one I'm reluctant to tell also, it is a competitive information. I don't want to sound off the competition this is a bit of a commodity market also. I think that is there. But however, I will give you this indication. We command premium compared to our competition in this, all across, and we are very uniquely positioned because we are one among very few who can claim to have 60 country payroll on single platform. And for that reason and for that breadth, we do command premium compared to our partner. In some markets, very good premium there, number one. Second, you asked on the Europe. We have almost covered the Asia. Your observation is right there. We have covered most of the market in the Asia Pacific. And Europe, we have around 6 countries already, and we are building another 6 we are building for the Europe also. I think that is in the progress, and that we will take step by step based on learnings we have had in building all this in Asia. We have started working with the what we call as the in-country service provider to start, and around with this aspect we are able to add another 60 more countries where we can provide managed services. However, for the platform, we are building our own capability, which is a continuous effort. We will continue to build for a few more countries, and we have started taking up Europe now.
Thank you very much, Mr. Sandesh.
Thank you. Ladies and gentlemen, this was the last question for today. I would now like to hand the conference over to the management for closing comments.
I would like to thank all the people who have joined here and investors for seeing through in the last few quarters, and we have been keeping updated, and we are looking forward for continuing this journey. And as we indicated, I think our all effort, entire leadership team is focused on into the area of whichever we are focusing, we show the growth, and we are we have intensified our effort for order booking. Hopefully that will conducive enough, and you will be able to see similar momentum coming into the next quarter. And hopefully whatever I said in the for the goals for the year to stabilize and come back to where we left, and we will be able to reach there. That is our first attempt, and hopefully we are able to see that, and in coming quarters we can have a conversation on how we are moving towards that. That is what we are looking forward for. Thank you very much.
Thank you. On behalf of DAM Capital Advisors Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.